All right, here I am sporting a brand new haircut. Very difficult to do in these COVID days. Feeling very positive because this is the last video for this course. The screen 126 says stages 10 and 11. It covers purchasing a business and franchising. Now, we're going to cover these two chapters very superficially. That, however, should be taken as a caveat, because if your business plan that you come up with for the course involves purchasing a business, then you'd better take a very, very, very close look at stage 10. Conversely, if your plan is for looking at the viability of purchasing a franchise operation or setting one up, then you'd better take a very close look at stage 11. In this particular video, also right at the end, there's a couple of points. After I did all the other videos, I realized there were some things that I should have said, and just in case I don't remember to talk about them when we're preparing for the exam, I'm going to add them here. All right, going to the next slide. It shows intellectual property with a $ after it and a lawsuit picture after it. The reason I bring this up is when we talked about intellectual property, the textbook is very, very specific about it, protecting your intellectual property to the greatest extent possible. What they mean by that is you should look at protecting your intellectual property, but there may be times when you just cannot afford to do it. Trademarks are... well, let's look at it this way. You can file a trademark yourself. I had one client come into me and he said, how much to file a trademark application? I said, well, I'll file it and I'll prosecute it, and you'll get your trademark for about $1,500 or less. And he went, oh, whew, wow, that's a lot. I mean, I looked online and you can do it for $300. And I said, no, you look online, the filing fee is $300. That doesn't necessarily mean the whole process. And he said, well, I'll do it myself. And then he came back to me and he said, okay, I filed the trademark application and they have rejected it. And they said, if I have any submissions to make, I can maybe resurrect it. I really want this trademark. What can I do? And I said, well, you can pay me $1,500 and I'll do the file. And he said, but I've already started it. And I said, okay, take $300 off that for the filing fee and pay me $1,200 and I'll take care of it. And he said, but I mean, I've done, all the work. And I went, no, obviously, if I bill you $1,500, it is filing the trademark application and prosecuting it. And I could handle those objections. I know I can because I've seen them before. And he said, well, just tell me how to do them. And I went, why would I do that, Chris? That would be like saying, hey, let me give you free legal work, okay? So you have to take that into consideration. You can file a trademark application yourself, and if you're lucky, it goes through no problem. But if there's problems, then you go to a lawyer. The lawyer's not going to give you a really sweet deal because you did most of the work yourself and then got into trouble. And the same thing about, and then to finish that off, of course, is what the book doesn't tell you is that once you've filed and you've protected your patents, your copyright, your trademarks, your industrial design, or have contracts to protect your confidential information, if someone infringes this, the government doesn't go after them. You have to go after them. And so you have to have deep enough pockets in order to commence a lawsuit to sue someone for breach of an NDA or a confidentiality agreement, or breaching a trademark. So those kinds of things, not in the textbook, and it's kind of irritating. The other one is incorporating a company. You can go online and you can do it really easily. I had one client that I said I would set up the corporation for him, and he said, how much? And I said, well, you're a startup, so $1,200, which is a pretty reasonable price. That's fees, disbursements, and taxes. And he said, whoa, okay, never mind, I'll do it myself. So he incorporated the company, and they tell you how to do that online, and then they say, and don't forget to constitute your company. And he didn't really know what that meant, so he ignored it. But when you incorporate a company, there's what you do online to incorporate the company and get a birth certificate for the company. And then you have to have constituting documents. You have to have a resolution of the initial shareholders appointing the directors. You have a resolution of the directors appointing officers. The directors that want to be directors of the company have to do a consent a document saying that they consent to be a director. And if you have to actually have the share certificates set up, you have to have a central securities register in the corporate minute book, and all these things the government doesn't do, and there aren't little blanks that you can do it online. So this client, actually I got the client after that problem. The client incorporated the business themselves, and then the tax department came in a while later when they were making fists full of dollars. It was a very successful venture. And the tax fellow said, could I please see your constituting documents? And so she gave them the certificate of incorporation that she got from the Registrar of Companies and the setup of the share structure. And he said, no, your constituting documents. And she went, what are those? And the fellow from the CRA was incredibly nice. He said, okay, look. He said, I am coming back. This is Wednesday. I'm back on Friday. You'd better collect those documents and show me. And the woman called me up and she said, okay, my husband and I incorporated this company, and the CRA is looking for constituting documents, because if those constituting documents weren't there, then they were going to be taxed on a personal basis, all right, as being owners, as in partners. So I prepared all those documents and she had them, and we were able to backdate them, which is legal because they were all supposedly, or they had all supposed to have been done on that date, and the fact that they didn't do them was irrelevant because you can backdate them. So anyway, we did that and everything was fine. So there's reasons why you hire lawyers, and reasons why you hire accountants, and reasons why you go to an insurance agent when you're setting up these matters. The book doesn't really deal with that problem. The last thing I want to mention on this particular slide is seed capital, because I think I talked about it when when BCD went down to Boeing and said, I am trying to raise money to develop my gun, and the guy gave him $35,000. That's what's called seed capital. Okay, it's not to help my client set up his business, to find his lease premises and to buy his equipment. It's just to get the prototype done so that he has a venture to do. Okay, and then you raise the rest of the financing later. Now, to get into the actual advantages and disadvantages of buying an existing business, on slide 128, you're going to notice the soapbox, because this is my opinion here. The first advantage says reduces the risk and it's easier to obtain financing. Those are two separate advantages. Okay, those are advantages, but they should be listed separately. Okay, it reduces the risk and it's easier to raise financing because you've got a track record. You can show the bank or whatever. The next one is good history, encourages the likelihood of success. That's pretty much the same as it reduces the risk. Okay, that's one of the factors that reduces the risk. And proven location, well, that's part of what reduces the risk as well. All right. And then it already has products and services produced, distributed. So again, that's, all part and parcel of reducing the risk. So I take exception with trying to break them out and explain them differently, but that's a very successful textbook. So the fact that they fleshed it out and are splitting hairs here is not a big problem. I just have to tell you that that's my opinion. It continues. The necessary equipment is already there, which helps. Okay, and the capabilities and the limitations of the equipment. I would think that was part of the reduces the risk as well, but they separated it out as something you should look at. Has established relationships with bank, trade creditors, and other sources of financial support. Okay, that's a good one. Business has established clientele. I think that's part of, sorry, which one was it? A good history. Okay, but anyway, splitting hairs again. These are factors that you can take into consideration. It can often be purchased at a favorable price depending on the reason for the sale. This is true. It may be that the person is retiring and feels that they've gotten the wealth out of their operation, and therefore they're willing to sell it at a reasonable price. Or it may be that they have health reasons and they've got to get out, and so they sell it at a reasonable price, or less than a reasonable price. So that's definitely an advantage. The last one isn't in his list, and he talks about this as a method of gaining financing, but I think it's just an advantage in and of itself, because if you have a corner store and you open up the corner store and you go, okay, I need milk to sell. Well, I'll just wait here till somebody comes by and gives me milk. And I need bread, and where's the bread? And people have eggs on their shelf in the store like this, but I don't have any eggs. What's going on? Well, you have to have suppliers. So either you set up your own business and you go and you hunt for the suppliers and you find the best ones that'll give you the supplies at a good rate. Or you buy an existing business and the suppliers are already there. The milk delivery is going to come and they're going to say, who are you? And you go, oh, I'm the new owner. They may ask you to sign a new contract, but hey, they're there and you know that it's worked for them in the past. Disadvantages of selling a business, and you can look at my soapbox there again. Physical facilities and equipment may be old and product and service obsolete. Those are separate disadvantages, and I think should be listed separately because they're very, very different elements. The next one says union management relationships may be poor. There are a lot of businesses out there, particularly in the province of British Columbia, that are not unionized. This textbook author is in Ontario. There's lots of manufacturing back there, lots of union management relationships. The easiest way to solve this particular shortcoming of the textbook is to say union management relationships may be poor if there is a union. If not, then there may be employer-employee relationships that turn out to be a problem. And then the last one says present personnel may be unproductive and with poor track record. Well, that's something that you talk about with the vendor, okay? And you may be able to discreetly find out the relationship by talking to some of the employees. So let's say there is a problem. The employer obviously is selling because they're one of those horrible bosses. Well, then you're going to walk into a situation where if you are a better boss, the problem dissolves. But if you buy it and it's not the boss, it's the employees, like that gas station fellow, the Shell station at Lonsdale and 13th that I talked about, if I was buying that business and he had been upfront and frank with me about the fact that the employees tend to steal them blind, or if I noticed on the financial statements an element for defalcation by employees, which means theft by employees, they can deduct that as an expense. You may not be able to nail the right person, so you don't go after anybody, but you want to recover. So it's in your financial statements. You know that the relationship is poor. If I was buying that Shell station, what I would do is I would tell the vendor, let everybody go, okay? You know the date of the sale is going to take place, so if they require 3 weeks notice or 4 weeks notice under the Employment Standards Act, then what you do is you say, okay, 3 weeks from now, your employment comes to an end. If at that point you want to continue working for the new owner, then what you have to do is negotiate a contract with them. Okay, so you let the person go. It's not wrongful dismissal because you've checked it out with your lawyer. And the new person comes to me and says, "Hi, I'd like to be hired." And I go, "No, sorry, thank you." He goes, "I'm going to sue you because you're, no. Hey, I'm new owner, So you can actually do that and hire back the ones that you want and hire new employees for the balance. Okay, so that is that. Disadvantages of buying an existing business. Accounts receivable may include bad debts. Well, yeah, it may, but why don't you do an investigation beforehand? Like it's not a disadvantage if you know about it. He's charging you money. He says, I have $28,000 on accounts receivable on the books, and I want to be paid for that. And you say, well, I've just aged these or looked at the balance sheet and income statement that you've given me, and those receivables, 20,000 of that is well over 6 months old, not likely to be collectible, so don't buy them off the guy. Okay, so it is a potential disadvantage, but it's a flag that should be going when you're buying it. The business has a poor location. Check the lease. If you can get out of the lease really quickly, then or if the lease is about to expire, then buy the assets of the business, but don't buy the lease. Leave the guy with the lease. Okay, inventory may include dead stock. In a grocery store, that could easily happen with non-perishable food items that just aren't saleable because people don't want to buy it. You can study the inventory records though and pick up some of that as a issue to be dealt with. You may inherit the seller's ill will with customers, suppliers, and financial institutions. That's true. That's the opposite side of the advantage that says, hey, those things are already there. They've got the customers, they've got the suppliers, and they got the financial institutions. You have to do some investigating. Okay. You can say, who are your suppliers? I should contact them and find out if they would be willing to, transfer the contracts of supply for me or to me. And when you're talking to them, if they say, hey, we don't want to deal with that guy at all because, he's, a deadbeat and he won't pay and stuff like this, you go, well, I'm a new owner, I won't do that. And you can go back and say, okay, we're lowering the price because of that. And then as an entrepreneur, it says you have less freedom of choice in defining the nature of the business if you purchase an existing firm. Tell that to Ray Kroc and McDonald's. Ray Kroc, there was a fellow already out there running the first McDonald's location and was doing quite well. And Ray Kroc wanted to buy it. And when he bought it, did he do quite well? No. What he did was he said, okay, I can take what that person is doing and as an entrepreneur, do it better. So as an entrepreneur, you're buying an existing firm, so this is not a new innovation, but you can bring innovative ideas to an existing firm. So it is a disadvantage. If you are not a very creative person, then it fits you. But if you are an entrepreneur at heart, then this really shouldn't stop you. Okay, nope, what did I do? Okay. Yeah. If the person is a corporation and wants to sell you the business by way of selling you the shares to his corporation, talk to your accountant, and if the accountant says this is an incredibly fantastic financial opportunity, purchase those shares because there's all sorts of reasons why, then go ahead. But also talk to your lawyer, because when you buy a corporation, you buy all the problems it has. Okay, so if I'm running a corporation and it's what's called contingent liabilities. Okay, if you purchase shares, you also acquire the business's liabilities in the way of lawsuits that the seller may not even know about yet, environmental liabilities that the seller may not know about yet, or tax assessments or reassessments with penalties. And I'll give you one real-life example. a lady came in to see me, and she wanted to buy a travel agency that sold tours to Japanese clients. It was run by a Japanese fellow who had two companies. He had the operating company, and then he had a holding company that held the shares of the operating company for tax purposes. You can do all sorts of fancy things. Talk to an accountant. Anyway, this business was making money hand over fist. And she came into me and she said, "Would you handle the purchase, please?" And I said, "Yes, but I would advise you to handle or to buy the assets. Do not buy the shares. So buy the computers and the debit card machines and all that stuff, but don't buy the shares." And she said, no, I want to buy the shares because, well, he wants to sell me the shares because he's going back to Japan and he won't need them anymore, and he paid some money for it, and I'm going to have to incorporate the company, so he'll give me a deal. And I said, don't. And he said, or she said, I have to be really careful here, because what she said to me was, he is Japanese and I am Japanese, and so he will not cheat me. And before you think I'm sort of made a racist comment here, stop and think that it was her that was being somewhat racist there. Because basically what she was saying, if I was selling the business to her, I might try to cheat her because I'm not Japanese, all right? So, but anyway, that's what she said. And I cautioned her against doing it anyway. She bought the business, and it was making money hand over fist. So what's the problem here? Well, the problem was that he had been paying his GST, okay? And she buys the business, and based on the sales that she was making, she started filing her GST. Now the tax department, it's an honor system, okay? You know how much revenue you made, you know how much GST you should pay it. The tax department doesn't know, okay? And so what he was doing is he was not selling or not filing and paying the right amount of GST. And so the tax department usually doesn't notice this for long periods of time. But all of a sudden, and they go, what happened here? Because the suspicion becomes they weren't paying the right amount before, or perhaps they're paying too much now. And so they came out to investigate, and they found out that he had not been paying his right GST. And they reassessed her $35,000 for unpaid tax GST, and they assessed her penalties, and then they charged her interest on the amount of GST that wasn't paid. Okay, and she tried to sue me. She couldn't sue him. He was in Japan then. I mean, she could, but it's not likely you're going to get any money. Fortunately, I had done a CYA letter, and if you're not quite sure what that means, then please ask someone else, because I cannot actually say it in a video or something, but it's a cover your something letter, in which I advised her not to buy the shares. And when the other lawyer called me up and he said, "I've been retained to sue you," I gave him a copy of the letter, and he called me back and he said, "Sorry to trouble you, Mr. Holden. She's not going to sue you." Okay. And there are times in your business when you might want to think doing that kind of letter. So that's a Japanese scenario, and again, I have to be careful here. I had another such operation where a fellow decided he was going to help his dad. His father was a driver mechanic for Budget Rent-A-Truck, and he had to do the cars and move from one trucks and move trucks from one location to another in the Lower Mainland. Got his third drunk driving conviction and lost his job. He had a mortgage payment and car payments, and so this was kind of desperate for the family. The son, who was a successful business person and a client of mine, stepped in and said, okay, Mom and Dad, look, we're going to go and we're going to buy a fish and chip shop, and you're going to run it, and you'll be able to pay the bills. And he came into me, and he had already signed the deal. Okay, this goes back to get your lawyer on time. Okay, don't come in and say, hey, I've done a great deal. What do you think? Anyway, he'd already signed the deal, and he said, would you do the purchase? And so I, was more than pleased to help them out. And I was sitting there, and I was going through the documents, and I said, there are no financial statements attached here. And the young fellow said, yeah, right. And I said, well, wait a minute. I mean, you're buying this fish and chip shop. How do you know it's making any money? And he said, oh, don't worry about that. And I went, oh, okay. Wait, no. I said, you hire lawyers to worry about these things. So how do you know? And he said, oh, because they told us. And I went, oh, okay. Like, whoa, wait. They told you? And he said, yes. And I said, but what if they're not telling you the truth? And he said, oh, don't worry. We're from a certain East European country, and so are they, and so they would not cheat us. Now, the point of the story is not to suggest that any particular race or whatever is going to cheat you or they're worse than the others. What is important here is when you're doing business, dot the I's and cross the T's. And if you say, okay, I need some financial statements, and they start dancing around saying, well, we don't have them for this reason, that reason, but, it's making a lot of money. And these people actually said that they had cash register receipts in their basement somewhere, and they would find them and give them to my client, which they never did. And so, again, I did a CYA letter and said, I know you've put some money down as a deposit, but it's my recommendation that you back out of the deal. Okay, and you say, we'll go forward with it if you can provide us financial statements. And they wouldn't because, hey, these guys would not cheat them. Well, they bought the restaurant, okay, and the restaurant was not making any money at all. Customers were staying away in droves. The father goes bankrupt, they lose their house, all right? So these contingent liabilities are of tremendous concern. And if it doesn't matter who you're dealing with, okay, if you say, I would like financial statements, and they begin doing the dance routine, there's all this different reasons why we can't do that. Or if you're buying something and they say they'll throw in something, and you say, okay, well, put it in the contract, and they go, well, why should we put it in the contract? The contract is what you're buying, and we're giving this to you, so, well, what happens is you have a written agreement, you buy the business, and the stuff that they were going to throw in, they say, oh, no, we're not giving that to you, and you go, whoa, it's part of the deal. Well, it's not part of the deal, okay? It's extraneous to the deal, and the courts will not consider that to be fraud. They'll say, you're kind of naive if you think, let them exclude it from the agreement. And the judge will say, if you thought it was important, why didn't you put it in? And going back to when you're making the deal, you look at them and you say, okay, I'm buying these assets, and you say you'll throw in this. I would like to put it in here and say nil value. And if they start doing the dance around routine with all sorts of reasons why it shouldn't go into the agreement, then little red flags go up, okay? And at that point, you just stop and you say, look, okay, so it's not necessary to put it in the agreement, but it won't hurt to put it in the agreement, so let's put it in the agreement. And if they're adamant that they're not going to do that, then you got to say to yourself, is this a good deal? Okay, buying a franchise. This will be done in like 30 seconds. Definition is on slide 133. It's a legal, commercial, ongoing relationship where a franchisor grants the right to a franchisee to sell the franchisor's products or services in return for a fee and royalties on an ongoing, which are ongoing payments. Okay, example of a single unit franchise is when you get a McDonald's franchise. Okay, The restaurant is giving food, which is a good, and services, which is the fast food. Your franchise fee for a McDonald's franchise, I looked it up and I can't remember. It used to be $600,000. I think it was Yeah, it is $800,000 because I think it's on the next screen. Pay $800,000 plus you have to pay these royalty fees on an ongoing basis. Single unit franchise, you buy one McDonald's location. An area franchise is like my Sylvan client, where they had an area of Vancouver and they could have as many locations as they wanted within that area. And then a master franchise would be when the company comes to you, and I don't have an example of this, but you'll get the idea. The company comes to you in BC and they say, we'll sell you a franchise. And then what we'll do is we'll make you our master franchise. So in other words, in BC, you have your franchise location and you are entitled to sell franchises for us. And then you make more money, okay? So you have a master's franchise for BC for a franchisor that is covering all of North America. Okay. Advantages of buying a franchise, obviously a proven system, easier access to financing, reduced cash requirements. I've put a line through there. If you think $800,000 for a McDonald's franchise is a reduced cash requirements, think about opening up a restaurant of your own, okay, and try to decide whether the amount of money you need for that plus the proven system makes sense, okay? I'm not saying it does or it doesn't, but, it reduced cash requirements, not if it's a solid franchise operation. Purchasing power. You do have really good purchasing power because, for example, you have all these buns that you need for your McDonald's franchise location. They have their own bakers and they have their own trucks to bring those to you. And because they make it on a mass scale for 10,000 franchise outlets, they can give you those buns at a very reduced cost, which is a real advantage. Advertising clout, McDonald's, yeah, absolutely. You open a McDonald's and you don't even have to put an ad in the paper saying new McDonald's location. People will find you just by the golden arches and things like that. There are some problems, and we saw that one with the franchise outlet where the Baltimore franchisor said, hey, you got to do television advertising. Okay, and my client in his area couldn't afford to do it by himself. They got creative. They formed a cooperative, and everybody pitched in money and got around that problem. Building equity, you build up your equity faster. Now, stress reduction, I just don't believe this. Okay, now you've got a proven system that gives you an advantage, but it's not like you couldn't handle that sort of thing yourself. You're still going to be under stress if you do your own or whether you buy a franchise. I mean, if I paid $800,000 for a McDonald's franchise and I had a proven system, I would still live in terror that COVID's going to happen or, some other disaster is going to happen, or that I'm just not capable of running my staff very well. On the Sunshine Coast, there's a McDonald's in Seashelt, and there was a McDonald's in Gibson's, and I think they're owned by different people because the McDonald's in Seashelt seems to operate really well. The McDonald's in Seashelt was pathetic. They went out of business. A McDonald's franchise that closes? That doesn't happen very often. That one should have. It was just terrible. So there's definitely stress involved. Disadvantages of buying a franchise, loss of independence again. Even more so if you're an entrepreneur, buying a franchise is not the way to go because you just cannot do anything without approval from head office. Franchisor's failure, you go online. I was on the MSNBC website, and they said 25 food franchises that failed. And I went through there, and there were all sorts of ones like the Red Barn, and ones like I can't remember the names of them, but there's a lot that have failed. So there's that concern because you bought the system and the system doesn't work, and the system breaks down, and suddenly you've got an outlet that you can't use the trade name for anymore. So it's a danger. Misunderstanding the franchise contract. This can be a problem. There can be something in there that you just don't understand, which costs you a lot more money if you didn't catch it at the beginning. Get accounting advice, get lawyer's advice. Minimizes the chance of that being a problem, but it could be. Misrepresentations of the franchisor. This has happened lots of times, and I think Uber got caught by that. We talk about it in the BADM 107 law class when they got into a lawsuit with one of their drivers in Ontario, and they had misrepresented the nature of the arbitration clause, which came back to haunt them. Payments of royalties in addition to the startup fee. This is a difficult one because you have to make those ongoing payments, and that could be a problem. Succession planning I have tacked on there because you are constrained a little bit with your ability to sell, or even pass it on to your children, because what happens is you say, okay, I've had enough of this. My daughter wants to take it over, and McDonald's says, no, I don't think so. And you go, no, I want to leave it to my daughter. No, I don't think so. You have to sell it. Because they don't have any confidence in your daughter, or your son. No, he was in 2 previous businesses and they both went bankrupt. No, we won't accept him as a franchisee. So there's that difficulty that you just can't leave it to whoever you want. You have to get their approval. Okay, that brings us to the end of the videos. That one not as long as the others, unless of course you're going to do a purchase of a business or a purchase of a franchise for your project in the course. The last screen says, if not now, when? And quite frankly, I've been bitten in the butt by that. I had that idea for the chart, which I could have made money on, but I didn't get in. So if not now, when? I waited and it was too late. I have had some other ideas which I think I have let go for lack of time and energy, and I've got one on the go now, and if not now, when? So my sister and I are thinking of going into business together, and it's I don't think it's as innovative as I would like it to be, but we're going to try to do some innovative things. And so if not now, when? And the same thing goes for you. You may not want to, so that's fine. But if you do, don't let the opportunity slip by. Thank you very much.